Everyone is waiting for a crash. It is the one word people understand. Crash means panic. Crash means headlines. Crash means a clear moment where something breaks. But what if that moment never comes? What if the markets do not collapse? What if banks do not fail overnight? What if there is no single day where everything falls apart? What if the real danger is not a crash at all? Because history shows something uncomfortable. The most damaging financial events often arrive quietly. They do not scare people into action. They lull them into staying still. That raises a disturbing question. If no crash is coming, then why do so many people feel poorer, stuck, and uncertain despite record markets and strong headlines? Tonight, we are going to uncover what is quietly replacing the crash, why it is harder to see, and why it may be far more dangerous than a sudden collapse. Setting the stage. How we learn to expect crashes for most people. Financial fear has a familiar shape. The Great Depression, Black Monday in 1987, the dot-com collapse, the housing crash of 2008. Each followed the same script. Prices rose too fast, risk piled up, something broke, the system snapped. Central banks, governments, and economists learned from these moments. Their mission became clear: never allow a visible collapse again. After 2008, the rules changed. Interest rates were pushed near zero. Money creation became normal. Emergency tools became permanent features. The goal was stability, but stability has a cost. And this is where the story takes a turn. Because preventing crashes does not mean preventing damage. It often means spreading that damage slowly across time. Origins. The quiet shift begins. The shift did not begin in a panic. It began in policy meetings. After the 2008 financial crisis, central banks realized something terrifying. Modern economies could not tolerate sudden pain. Debt levels were too high. Markets were too interconnected. Confidence was too fragile. So instead of allowing corrections, leaders chose suppression. Interest rates stayed low for years. Asset prices were supported. Liquidity flooded the system. At first it worked. Markets recovered. Confidence returned. Crashes were postponed. But the side effects started quietly. Cheap money rewarded assets over labor. Those who owned stocks and property grew wealthier. Those who depended on wages fell behind. This was not an accident. It was a trade-off. And the system kept moving in this direction. The rise. Stability replaces volatility by the 2010s. Markets behaved differently. Corrections became smaller. Recoveries became faster. Every dip was met with intervention. This trained investors to expect rescue. Risk no longer felt risky. Meanwhile, structural problems deepened. Debt climbed across governments, corporations, and households. Productivity slowed. Real wage growth lagged behind asset growth. The economy looked strong on paper, but underneath it was becoming fragile. Not fragile in a way that breaks suddenly. Fragile in a way that decays slowly. This is the kind of fragility people rarely notice. The breaking point. When nothing breaks here is the paradox. The breaking point is not a moment of collapse. It is the moment when nothing collapses at all. Inflation rises, but not enough to cause panic. Growth slows, but not enough to trigger recession alarms. Markets drift sideways instead of crashing. This is worse than a crash. Why? Because crashes force change. Slow decline does not. People adjust instead of reacting. They lower expectations. They work longer. They save less. They take on more risk just to stay in place. This is the new breaking point. A system that never resets. The fallout. Who actually pays the price? When crashes are avoided, someone still pays. Purchasing power erodes slowly. Savings lose value quietly. Housing becomes permanently unaffordable for new buyers. Wealth concentrates without headlines. The gap widens without protest. This is not dramatic enough to spark revolt, but it is constant enough to reshape society. You see it in delayed milestones. Later home ownership, later families, longer working lives. The fallout is psychological as much as financial. People feel like they are running on a treadmill that never stops. Failed fixes. Why solutions make it worse, every attempt to fix this system reinforces it. Higher rates threaten debt stability. Lower rates inflate asset bubbles. Stimulus boosts markets but deepens inequality. There is no clean exit. Policymakers are trapped by their own success. They prevented crashes so effectively that the system forgot how to correct itself. Each intervention buys time. Each one increases long-term cost. And the longer this continues, the harder it becomes to reverse. Modern parallels. The pattern repeating right now? Look at today. Markets remain elevated. Debt is higher than ever. Interest rates rise, yet borrowing continues. Inflation fades, but prices never return. Historically, this combination led to stagnation, not collapse. Japan experienced this for decades. Europe flirted with it. Now larger economies are drifting into it. The shocking part is not the data. It is the reaction. Most people are calm. They are waiting for a crash that may never arrive. And that is exactly what allows this system to continue. What is quietly replacing the crash? So what is replacing the crash? It is financial erosion, a slow transfer of value. From savers to debtors, from workers to asset holders, from the present to the future. It is not dramatic, it is persistent. That makes it more dangerous, because it changes behavior without being noticed. 3 clear takeaways. Takeaway 1. The absence of a crash does not mean the system is healthy. It may mean damage is being spread slowly instead of released. Takeaway 2. Stability can hide risk better than volatility. When nothing breaks, problems compound. Takeaway 3. Waiting for obvious signals is a mistake. By the time pain is visible, options are limited. A warning and open-ended thought: the greatest financial danger is not panic, it is comfort. When systems feel stable, people stop questioning them. They assume tomorrow will look like today. But history shows that slow changes reshape lives more permanently than sudden shocks. The question is not whether a crash is coming. The real question is whether people will recognize the quieter replacement before it becomes irreversible. Call to action: if this changed how you think about markets, stability, or risk, stay with this channel, because the most important financial stories are not the loud ones. They are the ones happening quietly right in front of us. Subscribe for deeper breakdowns of the shifts most people never see.